In theory, the central bank could do a better job than the market could. Maybe in theory it could be better than a gold standard or better than a Bitcoin standard, but in practice it's not. The constraint on Bitcoin of the issuance is both a benefit and a harm in some ways, right? So it's a benefit but that's also a constraint if you want it to be able to.
Thomas Hogan is an associate professor of economics at the University of Austin and a senior research fellow with the Bitcoin Policy Institute, BPI.
With experience at Merrill Lynch and as a consultant for the World Bank, Dr. Hogan brings real-world expertise to his cutting-edge research on banking regulation and monetary policy.
And again, in the U.S. history, we were almost always, for our whole history, on a fractional reserve banking system. You don't have to do that. You can grow your credit system without creating any new risk from fractional reserve. That said, I think there's a limit to how much that you can do for that. If the economy's growing and we just need more claims, then some people are going to use a fractional reserve system, and that doesn't mean it's inherently risky. If we got the Fed or other central banks backing their money by Bitcoin, I think that would be some constraint on them, but it wouldn't be perfect because, again,
Hello guys, welcome back to Less Noise, More Signal. I have another amazing guest today. It's Thomas Hogan, right, from the United States, I think out of Austin, Texas. Cool to have you here, Thomas.
Yeah, thanks. I'm glad to be on.
Cool. Yeah, and I sort of, you caught my attention when you were doing this other interview, I think, for the Bitcoin Policy Institute with some other great economists at some point that I might also have to talk to. And so, it was just amazing the sort of chat that you had over there. And so I was wondering, I have to bring you on to discuss a few things about Bitcoin economics and sort of how a Bitcoin standard potentially can also influence, the way the economy works or is working and might be working in the future. So, this is what I want to talk to you about. But maybe first, if you could introduce yourself and then maybe say a couple of words about the university that you're working at, that would be great.
Yeah, thanks. I'm happy to be on talking about Bitcoin and economics and the financial system, all fascinating topics. So I'm Thomas Hogan. I'm a professor of economics at the University of Austin, the brand new University of Austin. I'm also a fellow with the Bitcoin Policy Institute and a associate research fellow with the American Institute for Economic Research. I was formerly the chief economist for the U.S. Senate Committee on Banking, Housing, and Urban Affairs. I've taught at other universities like Rice University in Houston. And before getting my PhD, I worked in finance for about 6 or 7 years in investment banking and hedge funds. And so I have a wide background of, work experience in finance and also computer programming, and then teaching as an economics professor, and then also doing policy work in Washington, D.C. So it's a good perspective on a lot of the things that we're going to be talking about probably. But now I'm currently working at this brand new university, the University of Austin. We are literally in our first year ever. We have almost 100 students for our first ever freshman class. And I know some people know about this university and that it gets, like some Bitcoiners in particular know about it, but a lot of people don't. So I'll just say a little bit about it right now. So this university was founded, like I said, we are brand new. And the reason for our founding is because of all the problems that are happening at other universities right now. So our founders, Neil Ferguson and Barry Weiss, Neil Ferguson was at Harvard and saw the problems that were happening at Harvard. You can't have free speech, you can't have open discussions. And basically the bureaucracy of these old universities means that it's very hard to change. And so he and a few other people started talking about, like, let's just start our own university. Barry Weiss was at the New York Times, and she basically was chased out for being insufficiently woke. And she too talked about, like, look, we need a place for free speech. And so Barry and Neil got together with Joe Lonsdale, who is the co-founder of Palantir, and started this new university. We have a board of many other academic advisors from great universities, many of whom also wish they could institute more free speech policies at their universities. And so we're a university that is founded on the idea of open discussion. And so that's part of our ethos. something that we take very seriously. And in fact, we have a constitution that enshrines the free speech as part of our foundational or foundation of our organization. And so having a constitution means even if some administrator wanted to prevent us from having free speech, we could always, appeal to the constitution and basically sue. And so, we like to say, like, we're a lot like Bitcoin in a lot of ways. We're pushing back against the status quo. We're uncensorable. And we have that baked into our fundamental DNA in our constitution in the same way that, Bitcoin has the cap and everything in the code. And so we love that. We're big fans of Bitcoin. We actually have a Bitcoin endowment that was started by Joe Kelly, the co-founder of Unchained, and Unchained is helping us manage that. So we hold our own keys. We're planning to invest in it for the long term. We're not worried about the current prices right now and the fluctuations that are going on because we're long-term hodlers. And so we see a lot of connections between the University of Austin and the Bitcoin community. So I'm happy to be on here now.
Yeah. Nice. Wow. Very fascinating. So it's almost like as if you were sort of a Bitcoin university, like
Right.
right. Sounds like
I didn't mention I'm teaching a class on Bitcoin and cryptocurrency in our next term. So not very many universities have that. We'll have some people from Unchained and some other people that are in local Bitcoin organizations come and talk about it. So it's pretty exciting.
Yeah, it's very exciting. I mean, I've never heard about an actual university getting sort of founded. It was always like, as you said. I mean, here in Europe, you also have sort of like the wokeism and everything. And where people were sort of like, okay, we have to found some sort of counter movement, but then it usually ended up being sort of a think tank or just some other community. But I guess like the university that you're talking to me about, it's sort of is a state recognized university, right?
Yeah.
By Texas itself.
Right. Yes. So I mean, this was all happened in the last couple of years. So Neil Ferguson and Barry Weiss started writing about this about 3 years ago, saying we're going to found this new university. And honestly, I was skeptical about whether it would actually work out. But they were able to create the university, get certified by the state of Texas to offer an undergraduate degree, and raise a bunch of money to bring in professors. And so they were able to make it happen. We had our first term, back in the fall, and it was very successful. The students are unbelievably energetic, and a lot of them are here because they want to be able to discuss controversial ideas and topics, which you wouldn't do at a regular university. And so, it's a great place. The students, the professors, and the whole ethos of the universities has been great. But you're right, it's hard to do. I'm lucky to be part of this new experiment.
Yeah, I see. Very exciting, very interesting. Yeah, because now I get it. I always wanted. I've been to the States a couple of times, but never to Texas. But I always had like this somehow inner urge that I need to go to Texas, and now this is sort of confirmed. I know why. Because like a lot of good stuff is probably happening over there. So very, very nice to hear that. Cool.
Yeah, thanks. Yeah, we also the Austin is a great place. You should come visit, and you should come to some of the Bitcoin events here. We are in a building downtown that right across the street is the Bitcoin Commons, which is a co-working space for Bitcoin companies. And so we have great exposure to some of the event and Bitcoin things. We're co-hosting some events with them in the next couple of months. And so we're happy to have access to the local Bitcoin community. It's really fantastic. Austin is a great place for it. You should definitely come.
Great. Yeah, great pitch. No, I will come at some point. I have to come. That's I've been hearing so many good things, so that's for sure. Well, cool. Thomas, yeah, thanks for this introduction sort of. So I'd like to move over to the topic that I'd like to discuss with you. And as I said, I sketched out some of the context already, but I mean, the thing is, as a Bitcoiner myself, somebody's interested in monetary economics and then just economics in general, and I talk to a lot of people who are sort of having similar interests to me. And then this is the topic, that many people stress is like, okay, how can an economy or how might an economy function under a Bitcoin standard, And then usually when you talk to like your regular Bitcoiner, he's just like, okay, looking at this from a very black and white lens, So it's either going to be a fiat system or it's going to be a Bitcoin standard that we're going to be under. And I sort of have the suspicion, and I think you probably do hold this as well, that it's just going to be like evolving gradually, and Bitcoin will play an ever greater role, so to say, but it's not going to be the only money that's going to be around, you know? And so, yeah, I think it's much more interesting to look at these sort of marginal shifts that are happening with Bitcoin now being integrated into today's system. And yeah, this is also what I want to focus on with you. And I don't know if you agree with this sort of filibuster that I just laid out here, but yeah, that's kind of like my feeling.
Right. Yeah. So talking about the marginal changes is important as an economist. That's what we always think about, right? Is you're having these small incremental changes. And sometimes we kind of have an idea about what's going to happen, and sometimes we don't. And it's a little bit difficult, I think. So one question is first, like, what do we mean by a Bitcoin standard? How widely is Bitcoin being used? Is it being used only as a reserve for other monies that are being issued on top of that, like some kind of redeemable currency? Thinking about how that works is really important. And part of that, I think, is the fact that if you're having Bitcoin as the base money, then it does have the constraint that everyone knows about, that we've got this cap, we've got the regular issuance schedule, and at some point we're going to hit the cap, right? And so that's what everyone thinks is going to determine the money supply. But really, a financial system is a lot more complicated than that. And so you probably are still going to have some kind of credit system. You're going to have borrowing and lending, and you're going to have other substitutes, especially if Bitcoin is only the base layer and you have other things built on top of that. Then thinking about how that whole system is going to work together is what's really going to be important for thinking about economic activity in the long run, not just thinking about the cap, right? The cap isn't the only thing that is going to determine that. Sure, it plays a role, but then thinking about like, how extensively is Bitcoin going to be used as the base money? Is it going to be the reserve for all the banks? Is it going to be the reserve for other countries that are issuing maybe fiat currencies or redeemable currencies, right? If it's redeemable for Bitcoin, then it's not really fiat anymore, right? But the government can still have some role in managing the money supply. And so, thinking about these different institutions really can change a lot what you think is going to affect the economic role of Bitcoin and how it'll affect economic growth or economic activity in the long run. So yeah, I'm happy to talk about all those things. Where do you want to start?
Yeah, as you said, as I understand, like base money, this is really like a concept that is probably foreign to most of the people. Money is already something that most people really don't think about, but then like differentiating between like different types of money and then like base money, which is, as I understand, really, instrumental to the discussion that we're having in the end. And so kind of like my thinking, when maybe we can start there, and say, as you already laid out, Bitcoin is sort of different in terms of being a base money, but then how is it different, in terms of what we have today, like, or compared to what we have today? And then also, what is sort of acting as a base money in today's fiat system? And then maybe the third question is like, will it have to be either or there as well? Like Bitcoin is the only reserve money and base money that we're going to have in the future, or is there also going to be like sort of two things that can serve as a base money? So lots of questions there, but maybe we can start there.
Mm-hmm. Yeah, sure. So let's start off talking about the base money and how it works in the economy today. So in the United States, the U.S. dollar is the thing that we use as money. But we have the actual dollars, both in terms of printed currency and also reserves at the Federal Reserve that serve as base money in the U.S. So, those two things, one is that we print out these dollar bills, and we distribute those in the economy. And, that's some portion of actual spending in the economy. But as we know, most spending is electronic these days. And so most of the new base money comes from banks that hold accounts at the Federal Reserve. And when the Federal Reserve wants to create new money in the system, it basically just credits their accounts. So typically the Fed will be doing open market operations. That is, it buys bonds in order to create new money. So it's taking bonds out of the economy and it's putting money into the economy.
This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL.
And the way that it does that is that it's got a list, just like a regular accounting list of all the banks that have deposits at the Fed. And when it buys bonds from those banks, it gets the bonds and then it credits new money on their account at the Fed. So those banks can hold on to that. They can trade it with other banks, but they can, the important part for economic activity is that they are then going to create other loans and create things that use that as the base. So, it used to be in a more simpler pre-2008 world, it used to be the case that the Fed would do these open market operations. They would inject some money into the banking system, and then the banks would hold about 10% of that as a reserve, and the rest they would lend out, right? And so they would create a loan for somebody that wanted to borrow money for a mortgage, or a business that wanted to build a factory, right? And then that person or that business has that money and they go out and spend it. And the person that gets that money then deposits into their bank, and their bank holds a little bit, 10% as reserve and lends the rest out. And so it has this multiplier effect, right? And so it used to be that we had a pretty good idea of how the overall money supply was going to be affected by injections of base money by the Fed. That's no longer the case in the United States. Since 2008, the Federal Reserve has been paying interest on bank reserves, which means banks now have an incentive to hold more money at the Fed, right? And so in 2008, the Federal Reserve started doing this quantitative easing policy where instead of buying, say, a few $100 million, they suddenly started buying trillions of dollars of bonds. And a lot of people were worried that that was just going to create massive, massive inflation in the United States. But it didn't. It didn't, because the Fed was paying the banks not to lend that money out. They were paying them to hold it at the Fed. And so, that causes some problems because, at least in terms of understanding what's happening with the monetary system, it no longer is the case that just putting new base money into the economy is going to end up creating more total money. If we look at broader measures of money like M2 or M3, there's another measure called divisia that's sort of a weighted measure of different types of money. And all those things, they just don't go up as much when we inject base money. And so, it's no longer clearly the case that that changes in base money are going to affect the money supply. So on one hand, that makes it harder for us to understand what's happening when the Fed puts new money into the system. On the other hand, it's kind of a lesson that, well, look, the base money is not always the thing that determines broad money. And so thinking about financial intermediation is going to matter a lot for Bitcoin and the way we think about that, right? So thinking about the financial system that's built on top of the Bitcoin standard will matter a lot. Let me say one more thing about the gold standard. So the gold standard was previously a little bit different because the base money was gold, and so gold is something that's going to respond to changes in supply and demand in a better way that, say, the Fed is. The Fed, right, in the United States and probably all other central banks, they're going to try to steer the economy and potentially manipulate the economy. I mean, it's kind of their job, right? They're supposed to be stabilizing the economy. It doesn't always work. Frequently, they cause more problems and actually can make the business cycle worse. But they're trying to smooth out the business cycle by, putting money into the economy when they think it needs money and potentially slowing monetary growth when they think there might be a bubble or something like that, right? The gold standard responded more to changes in supply and demand. That is, producers of gold, when they see prices are going up too much, or when they see prices are high, that means the value of gold is declining. And so they're not going to produce as much gold. Whereas when prices are potentially going down or not growing very much, that means a stronger value of gold. And so they're going to produce more. And so they're going to automatically kind of balance it out because they respond to supply and demand just like any other part of the economy, right? And so that means the banks then are also going to be getting new gold reserves that they, like the banking system today, they can create gold. I mean, they can create loans, right? And so this is in, most of US history, we had a fractional reserve banking system. And so they're doing this lending thing. When they get new gold reserves, they're going to lend them out. But banks, just like other businesses, they have a problem if like they can't lend too much unless people are going to be demanding that money for loans, right? And that's going to affect interest rates, going to affect other things in the economy. And so you tend to have a more sort of market-based equilibrium in the monetary system that you don't have on the Federal Reserve that's going to be, manipulating the money supply. And so I think that's, that gold standard system is going to be a little bit more like what we might have on a Bitcoin standard, where you have financial entities that might be private companies or might be DeFi protocols or other things. They're going to be creating money on top of the base money, and they're going to be responding to customers and responding to supply and demand in a better way than the financial system is doing today, because today's system is more easily manipulated by the government.
Yeah, great. No, for sure. I want to come back to this comparison, when you sort of link it to the gold standard and how that might be sort of a mirror view into how Bitcoin could potentially work as well, or sort of a Bitcoin-based system. But maybe go back to this one thing about the base money that you were laying out there, because you neatly explained how there's central bank money, these bank reserves that sort of are held at the central bank by commercial banks, and they are sort of the textbook based money that you find, But then you also talked about the bonds, usually government bonds, that are sort of in that equation as well. And I regularly hear people also referring to bonds as a sort of base money component, And so maybe if you could untangle this for us as well, is it sort of the same thing, but for different contexts? Or what is the difference between a bank reserve or sort of a government bond then,
Right. Yeah. So it is the case that some big banks and financial institutions, they use government bonds to trade amongst themselves rather than using base money, just because they're big and they're liquid and they're easy to move back and forth. For normal people, no one would be able to do that. So like I mentioned, there's this measure called divisia that weights the different types of money and how they're used and basically their level of liquidity. So you can think of cash as being, one of the most liquid things that you can spend at any time, at any place. And then you have deposits in your checking account, which at least in theory are redeemable at any time. And you can write a check or you can use a debit card in order to transfer those. It might be the case that you have a problem with your bank or something else in the system that causes a delay. And it can also be the case that may take a few days for the bank to transfer the money and some time to settle. So demand deposits are basically almost as liquid as cash. And then you have these other things that are a little bit less liquid and a little bit less liquid. And so treasury bonds fit into that at some level. They're a little bit further out because they're a little bit harder and they're something that regular people just can't use. But they are used kind of as money in the financial system. And so it's kind of one of these questions of like, okay, how big is the frame that we're looking at? Are we looking at like everything that could be possibly used as money, or are we looking at the things that are most practically used as money? Or sometimes like the divisia, where we're weighting these things by how liquid they are and how widely they're traded as money.
Yeah.
And so that for the question of how is this going to affect the economy, looking at that big picture question of all the things that could be used, I think is kind of important. But for understanding the fundamentals, I think it's easier to just think about like the base money as being the thing that's going to affect the changes in the money supply.
Yeah, I see. But then again, if I tie this back, if I tie all of this back to like the fiat component of today's system, so to say, be it like base money, bank reserves, or be it then sort of bonds, or whatever other sort of money there is, I feel like, yeah, all of them are not practically scarce, in a sense, or in the same way that Bitcoin is sort of scarce. And there, for me, there's like the biggest distinction, between a sort of Bitcoin on the base money layer, as well as then all these other things, because with Bitcoin, you have this clear cut 21 cap, and we know we haven't found a way as of now to sort of expand the Bitcoin supply, and hopefully, and probably never will. But then the thing is, like, with these other stuff, there is, and so there I see like the main distinction. But then when I listened to you before, you were sort of arguing that even though, like, in the fiat system as we understand it today, like base money can be easily manipulated and increased, they sort of have also found a way to kind of neutralize it, as you said, with these sort of paying interest on these base money reserves and stuff. And there it would not sort of then like translate into inflation. Monetary inflation might be there, but not like high street inflation or some other things. So the question is, is this sort of then problematic for Bitcoiners, because they're always saying the sort of traditional system fiat is really inflationary, although it doesn't have to be, or the more sophisticated it gets, or how can I sort of solve this conundrum?
Yeah. I mean, partly it comes down to like, how much do you trust the central bankers? In theory, the central bank could do a better job than the market could. Maybe in theory it could be better than a gold standard or better than a Bitcoin standard, but in practice it's not, right? And so, so definitely the Federal Reserve has the tools to be able to control the money supply. They have a couple of inherent disadvantages that, the monetary policy from the Fed, it takes somewhere between 6 to 18 months to affect the economy. We call it, say, long and variable lags, about a year on average. They need to be thinking a year out. What are they going to be doing? They're managing one money supply, unlike when you have lots of private money creators, like on a gold standard, that some people are going to produce too little and some too much. But the Fed's got one, and so if they mess up, like, everybody's gonna have problems. But they would say, oh no, that's an advantage for us, because if we get it right, it's going to be better for everyone, right? And so that is when you said, like, they have a tool of paying interest on reserves. When they started doing that, that's exactly what they said, is like, oh, well, we have this extra tool now, so we'll be even better at managing the money supply. But then we got a ton of inflation, right? And even when they first started doing that in 2008, I think they didn't understand how powerful it was going to be. They actually thought, coming out of the Great Recession in the United States, that we were going to have a bunch of inflation. And in truth, they actually undershot the inflation target and GDP target for the next couple of years. And so we had a really slow recovery because they neutered essentially their own monetary policy. So the economy just couldn't start growing. And so we have periods where the Fed has created a lot of inflation, like, the post-COVID period in the 1970s, the stagflation that we experienced at that time. And then we have times when they've created too little, like trying to recover from the Great Recession, causing the Great Depression in the United States. In the 1920s and 30s, the United States was still on a gold standard at that time. But basically the gold standard, the Fed was manipulating the gold standard and basically put too much money into the economy in the 1920s that caused this boom. And then at the end, they see that we're having a bubble. They try to end that. And so they contract the money supply, which leads to recession. And then instead of lending to the banks like they were supposed to do to, help support the banking system, they contracted the money supply again because they didn't understand that what they were doing caused all these bank failures. And so, monetary economists widely believe that the Federal Reserve was really the cause of the Great Depression in the United States. So that was basically, that was a big deflation because they weren't putting enough money into the economy and didn't understand what was going on. So if you believe that they're going to use their tools effectively, and certainly the Fed has done a good job convincing people, like, we saved you in the Great Recession, we stopped all the inflation in the post-COVID period. I think really, people that are looking at it critically think like, no, you actually caused all of those problems. And so, yeah, if you believe that the Fed was going to do a good job, or any central bank, they potentially have the tools to do better in theory. But in the real world, it's better if we have something like a gold standard that is tying the value of the money to some specific good, or potentially a Bitcoin standard if we know that the Bitcoin value is not going to be inflated by increasing the supply.
Yeah, exactly. No, that's a great way to think about it, actually. That in theory, yeah, for sure, they have the tools and they could, like, if they are sort of, if they are demigods or gods themselves, then they can sort of manage it, because they have the tools and you might know how to sort of, yeah, tinker with the system in order to get it right. But then again, reality just lots of times shows that this doesn't work out. And I think it's sort of, just to quote this other famous economist, Friedrich August von Hayek, he was sort of writing this book where he sort of said the fatal conceit, you guys will never be able to manage such a complex system. And I think, yeah, it was also said by Satoshi himself when he was sort of laying out that, yeah, you have to trust the bankers, the central bankers, to sort of manage the money supply. It's really this trust component then. And that's how I've grown to think about it in terms of Bitcoin versus central banking or just fiat. It's really, Bitcoin is really there to nurture the man, as you said as yourself. It's really like, yeah, you can't tinker with it because there's no possibility, there's no lever to pull, and that's so interesting. Whereas with the other system, yeah, in theory, if they were perfect, they could obviously do this, but history has just shown again and again that they don't manage to do this.
Yeah, and we know that that's why Bitcoin was created. People were trying to find some other form of money that wouldn't be manipulated by the government. There were multiple other attempts before Bitcoin. People that were trying different electronic currencies. Hal Finney and Nick Szabo were coming up with their own and trying different ways. And there were also experiments where people were trying to use electronic transfers of gold or other things. And, everything that they did, the government would crack down and basically send people to jail for experimenting with these things. And so they finally decided, look, we need something that's completely outside of the control of government, that's going to be decentralized and can't be taken over by one entity, so that we can, protect ourselves from the exploitation of the government.
Yes, yes, great point. Well, exactly, yeah. Now, I think now that we've established this difference, between like these like base money type difference that there are sort of, yeah, obviously the critics, and we already alluded to this, they're coming along and saying, okay, Bitcoin, yeah, I know there is a difference, it's scarce on the base money layer, but then you have the problem with deflation, because like a scarce money or a scarce base money can power a ever growing economy, and I think you already now sort of counteracted by saying no, there's going to be sort of a credit system and just a higher layer money system on top of this developing. Can you maybe flesh this out a little more? How would this exactly work, and how would the connection be between sort of a base money, which would be Bitcoin, and then the higher layered money on top, which would be sort of credit instruments and stuff like this?
Mhm. Yeah, so part of this would be, similar to what we see today, where you could have a banking system that was based on Bitcoin as the base money. And this was an idea that has been talked about. Hal Finney has said this is what he thought was eventually going to happen to Bitcoin, was that it would be widely used, where Bitcoin was like the base money, and then there's this other financial system built on top of it. And that's great because it solves one of the problems of the Bitcoin not being able to respond to changes in supply and demand or changes in the demand for money, right? So this is both the constraint on Bitcoin of the issuance is both a benefit and a harm in some ways, right? So it's a benefit because, like we were saying, people didn't trust that the government wouldn't inflate, and so we put in this hard code where it can't be changed and it can't possibly be inflated away in terms of the issuance, right? But that's also a constraint if you want it to be able to grow and to support more transactions. And of course, this too has been a long time tension for Bitcoin. I mean, it's the reason we had the block size wars, right? As people wanted to be able to use Bitcoin for regular transactions. It's the reason that we have Lightning. And so getting around that constraint has been a big issue for Bitcoin in terms of being able to support transactions and support growth. And so some people like rightly question, like, look, we've already got this problem of wanting to do more transactions and wanting to grow. but we just haven't been able to. And one of the reasons we haven't done that really is we haven't been able to build another financial or banking system on top of Bitcoin, right? And so how would that work? I think there are a couple ways that we could think about it. One is just like traditional banks. We have banks that aren't currently legally allowed to use Bitcoin in transactions and use it for collateral and hold it. But that's all changing now, right? I mean, hopefully, we're seeing this big new change under the Trump administration. We're seeing the end of Operation Choke Point 2.0. And hopefully the banks will be able to hold Bitcoin now, which means they'll be able to use it for facilitating other transactions. Some financial companies you've already seen in the last couple of months that are doing loans that are pairing the collateral of Bitcoin with other assets. And so they're starting to use this in financial transactions already. But people aren't really using it as money yet. They're using it just for these new types of financial intermediation where the money involved is still like US dollars or whatever. And so one of the questions will be like, okay, so do we see banks starting issuing claims redeemable for Bitcoin? Do we see, say, a DeFi system built on top of this? Do we see an L2 built on top of this? Right now, we've had the legal limitation on banks and other financial intermediaries, but we've also had this technical restriction that we just haven't been able to build L2s on Bitcoin. That too, it looks like there's new developments in that may make that possible. And so I think that is probably a likely outcome that we'll see probably, L2s that have DeFi capability built on Bitcoin. I think we'll see redeemable claims for Bitcoin. I think we'll have to, if we want to continue doing small transactions, to be able to do this. Like if you just think about the divisibility of Bitcoin, 8 digits, right? We get 8 zeros after the Bitcoin, after the one. 8 decimal places, and which seemed like a ton, when they in the early days, and people maybe thought we would never run out. But look, once we get to a million, $1 million is what is like one cent per sat, right? And so at that point, if we want to still be being able to do transactions in cents, we've got to have something else. We've got to have like an L2 or something that's going to have more divisible digits after that. And one of the early things that people had talked about Bitcoin and other cryptos being used for would be, say, micropayments, where you're doing a fraction of a cent, right? And if you want to do that, then we're already at the place where, look, we need some kind of other L2 or something else that's going to allow us to do these smaller transactions that we can just no longer do even with sats today. And so I think something like that is probably pretty likely. And if you have that, then you can build sort of a whole credit system on top of the Bitcoin network with Bitcoin being the basement.
Yeah, it makes a ton of sense for me in the end. Also, like theoretically, like from a theoretical economical perspective, so to say, because when we say that Bitcoin really is the base layer money, so to say, of such a new system, then again, it must be compared to like central bank money, which again, as you said, nobody today, or as you said before, nobody today is handling central bank money directly. We as the normal people are not dealing in bank reserves, and we're not dealing in treasury bonds and stuff like this. This is for the higher, like the more loaded people, sort of lower down the stack. And the same would probably be with Bitcoin in a future that we're sort of painting here. Where Bitcoin on chain might not be moved by us normal people anymore, and we would sort of transact higher up in this multi-layered structure, so to say. That sort of makes sense. But like, how would sort of the actors of that system, within the credit system and within the economy, how would they sort of be? How would their incentives and maybe also just their behavior swift or switch, or swift, like how is there anything that we can say there? Because like if you are tied to a sort of a scarce base money, I would assume this sort of makes something with the actors in that system. It changes the behavior. Can you say something to this as well?
Yeah, so I think that we can think about sort of multiple levels. I think at least the first level might be claims that are directly redeemable for Bitcoin, and maybe there's a limited number of those, and maybe you have to have a reserve, like as if you're a stable coin. I mean, maybe these will literally be stable coins where there'll be other tokens that are tied to Bitcoin, but they provide some additional functionality, like being divisible or maybe being cheaper to transact rather than through the Bitcoin network, like Lightning or something. And so thinking about, first of all, I think we'll have to have something that makes those transactions a little bit easier and redeemable for Bitcoin. But then once you have that, it's easier, I think, to build a credit system on top of that. So, so the credit system is a big advantage because it means you're no longer tied to the exact quantity of Bitcoin, but you still have some link back to Bitcoin itself. So you can expand a little bit, but not too much, right? So the example that I think about this is, going back to the gold standard, we do have banks holding gold at that time. We do have them making paper notes that are redeemable for gold. That if you want your, gold instead of the dollar bill that you got, you go into the bank and they'll give you a piece of gold, right? So this is like a stable coin. This is a, real world meat space stable coin. And so they can do that, but then they can also make loans, which is credit. And again, in the U.S. history, we were almost always, for our whole history, on a fractional reserve banking system. You don't have to do that. I mean, we do have things like DAI and other stable coins that are being created that are fully collateralized. And so you can only borrow some amount of what you've deposited there. And so you can at least, for a little while, you can grow your credit system without creating any new risk from fractional reserve. That said, I think there's a limit to how much that you can do for that. Like at some point, the amount of money that you're going to need for the economy to grow and grow and grow is going to be greater than the amount of collateralized Bitcoins in a risk-adjusted sense that you can't, borrow some percentage, more than some percentage of your collateral. And so yeah, I think this is a bit of a problem because Bitcoiners don't like fractional reserve and thinks it's gonna cause a lot of risk. I think historically, actually, when we were on the gold standard, I think that was not one of the main things that was causing risk. Like bank regulations were causing the real problem there in the pre-Fed system. And so I think that there are basically relatively safe ways that you can do a fractional reserve banking system, even and that will allow the economy to grow and grow and grow, even when you have a base money that is not growing. In fact, George Selgin wrote about this in his book, The Theory of Free Banking, and talked about how, look, you can have banks that are responding to supply and demand. They can't create too much money because their demand, people won't be demanding it. And so any one bank can't really create inflation in the way that a central bank can. But at the same time, they can expand to accommodate demand. And even though it makes it a little bit more risky for them individually, if everyone is doing that in the system, it just means that the collateral becomes a slightly smaller percentage of the outstanding claims. And so you can maintain some level of safety in the overall system, even though you're on a fractional reserve system. And so I think, he has a whole book about how this could work, but he was talking way back about the gold standard and how it would work on a regular banking system. Same thing could be applied today, I think, to a Bitcoin standard.
Yes, and I would have the feeling that it would, in reality, just because, as you said, a lot of Bitcoiners don't like fractional reserve banking, and they're sort of really just for the full reserve banking. But I think if you really sort of stick to reality and sort of try to think how this would unfold in a real world, I guess there's going to be the entire spectrum. As you said, there's going to be like the full collateralized stable coin, but then there's also going to be like the fractional reserve section, and some banks might be more prudent than others, and so yeah, it's just going to be an open free market, and I would assume you would see all of these things and not just one type way where people would go. Yeah.
Yeah, and I think, that's what Hal Finney had in mind from the beginning when he was talking about that, and I think, like you're saying, you're right that giving people choice, I think, is a good idea, that people that only want the very safe ones, they can do that. If you only want a safety deposit box and you wanna make sure that your stuff is there in the bank, you could do that in the banking system today too, but I think it's easier on chain to give people the option of, you can have one that's totally secure and not worry about that. Or if the economy's growing and we just need more claims, then some people are going to use a fractional reserve system, and that doesn't mean it's inherently risky.
Yeah. Yeah, I see. Like one thing I usually also sometimes hear Bitcoiners say is that they're thinking like, okay, in a more Bitcoin prone or Bitcoin based system, like all the players that we now mentioned in the credit system, they're going to be a lot less of risk takers. It's going to be less risk and stuff. And I was wondering, is this really true? Because I feel like human nature is always the same, and people are still going to be sort of taking risks, and maybe in the long run this is going to go down a little because you don't have sort of a base money creator, who can sort of bail out the people who take like unnecessary risks and stuff. So this might have some like a loop or like a feedback loop on you, that you're then sort of, okay, I've seen others take this risk and then they weren't bailed out because it's not working. So, okay, I have to be more prudent, but probably there's going to be risk taking as well. And in the end, maybe in the Bitcoin based system, it's just going to be sort of more regular cleansing then, which is going to be shorter in time, but it's not going to be sort of this redistribution of base money and bailing people out in the back and stuff. So that might be the difference, which makes the entire system, after all, a little fairer. That might be a point. I don't know if you agree or have any thoughts on this.
Yeah, um, uh, so part of it depends on sort of like what kind of system we're talking about. I mean, today when we don't have any credit system built on Bitcoin, when we're trading Bitcoins themselves, then we have this situation where the supply does not adjust, and so that means any changes in demand are going to be directly reflected in the price. So people that are coming in and trading all the time, if that trading is going to create some volatility, then the price is going to be volatile for sure. But if you have a credit system where people can borrow against it, then the credit's going to adjust and it will stem some of that volatility, right? It's going to calm it down a little bit and give people some options, and hopefully that will potentially have the opposite effect, that it will allow people to hedge a little bit more, right? And so will calm down some of that volatility. The other thing that's funny right now is the more so it's like a little bit counterintuitive that you would think that if there are more people holding Bitcoin, that it would make it a little bit stable, and so the increase in the market of Bitcoin is going to sort of stabilize the price a little bit. But that's not true if those people are hodlers. So if you can think, it seems like, well, look, you have more people participating in the market, and if it's a bigger market, then that's going to mean more suppliers and demanders, and therefore that's going to make the price fluctuations a little bit smaller. But if those people are really taking that Bitcoin out of the system, if we're holding it for a long time, that means a smaller and smaller amount that's out there to trade. And so then you have even bigger swings when demand is changing and there's just not very much supply because all that supply is being held for the long term. That really exaggerates the volatility a lot. And so that too, it's like if people are holding that, if that becomes a reserve, then that money is going to be held for the long term, but there will still be some credit that can respond rather than having like no response right now for that. And so I hope that kind of system, that a credit system built on top of a Bitcoin standard, would be a little bit more stable. The other thing that is a little bit different now than if we're talking about long into the future is that the returns also for Bitcoin are potentially much higher now, whereas in the long run, they may not be as high. Because right now we're expecting all these people are going to be moving in. We're going to have much wider use. Tons of people that have no exposure to Bitcoin are probably going to be gaining it and adding. And in for us to reach that level of being like a Bitcoin standard, then many more people are going to have to come in and own Bitcoin or own claims to Bitcoin. And so for at least for a while, that's like number go up, right? But that won't happen forever. Once lots of people own it, then there won't be as many potential buyers and people will be more comfortable with it. And so that too is going to, in the long run, just decrease the volatility.
Okay, so then you're telling me you are of the belief that at some point Bitcoin's volatility will have to come down because, like, from the first part of your sentence or sort of your explanation, I was like, yeah, I do agree because, like, the hodlers actually do increase volatility because they're taking it off the market, and sort of like decreasing supply, and because with Bitcoin you never do have a possibility. Again, we come back to this base layer discussion to sort of react to sort of like demand shocks, because like supply is just fixed. So I was really wondering, is it ever going to be stable to serve as a sort of everyday currency? Or again, is it just going to function as base money and people will come up with other stable versions, which then might be called BitCredit or whatever? And they're not going to be Bitcoin itself, but they are sort of then a fiat credit money based on Bitcoin, which has then maybe more the possibility to be stable for some reason, and it's not Bitcoin itself who's going to be used as the actual currency, if you know what I mean.
Yeah, for sure. So let me make an analogy to the gold standard here. So if we look at gold today, that too is a pretty volatile market. Not nearly as volatile as Bitcoin, right? But compared to a lot of other assets, gold is a pretty volatile market, and partly because it's held as a hedge against inflation. It's something that's going to keep its value, and a lot of people want to hold that if they believe there's going to be a lot of inflation, which then means it's subject to all kinds of other shocks, like anything that you think is going to affect the economy could potentially be affecting the price of gold. But that wasn't the case when we were on gold standard. When gold was being held as the reserve, it was tied to the value of your money. And so even gold that was outside of the monetary system, if it was being used for other purposes like jewelry and plateware and things like that, that gold market just wasn't nearly as volatile as the way it is today because, everyone had it and everyone had access to it. And so it just didn't matter. It didn't fluctuate very much because it was tied to the value of your dollar. And that in the United States and in most other countries made the long-term value of the dollar or whatever currency very, very stable over the long run. There are always some fluctuations in the short run, but it just wasn't nearly as volatile as once you go off the gold standard and people are holding it for hedging and they're speculating and all these other things. That's more similar to what we have in Bitcoin today. Whereas at some point it hopefully will become so widely held that people just don't need it for those other uses and they're not widely using it for speculation in the way that they are today. It's something that's more directly tied to the value of our money and to what's going on in the long run in the economy rather than all these short run fluctuations.
I see. Okay, interesting. Well, I mean, I wanna wrap this up sort of, but I do have this question still, which is I'm pondering on, and which is in my mind, sort of like we've talked through all these sort of shifts now that might be happening with Bitcoin, and also like again, these marginal shifts and stuff that's happening or it might be happening in the economy. So yeah, like yeah, it's all sort of out in the future still, but can we already say that Bitcoin has some sort of effects right now on the economy, and we can sort of point to it, to some tangible effects, if you know what I mean? Because one example that I want to give is sort of also some Bitcoiners are hoping that governments at some point will not be able to spend as much anymore, because like Bitcoin is sort of curtailing them, or banks might not be able to spend that much and all these type of things. But then as of now, I have the feeling, Bitcoin is not yet big enough. Maybe it's because it doesn't have this credit system built on top of it yet. It doesn't have this penetration that it needs to sort of really have these type of effects. And so I'm wondering, are you seeing any sort of effects already now that we can pinpoint?
I don't think so. So part of the reason is that, people are holding Bitcoin right now mostly as an asset everybody number go up. Like that's driving a ton of Bitcoin adoption right now, and not really trading and using it as money, right? And so going back to like that was one of the decisions about the structure and in the block size wars and everything was, look, we wanted to have a cap on it, and that made it harder to trade, and so it hasn't yet become widely used as money. And I think potentially having L2s or credit available for Bitcoin or using it as a reserve for banking is gonna help that more. Right now, I don't think it's doing that as much. I think the Federal Reserve and other central banks are starting to see it as potentially some kind of threat that people could use this instead, but they're not really doing as much right now. I hope that um, that will become easier. Like one of the difficulties in the United States is not just the technical problems of Bitcoin and that it's hard to trade, but that it's the legal barriers to doing that. You can't use it in your bank or have any kind of bank credit created from that. You can't if you trade it right now, it's taxed as an asset, and so then you have to think about like for every transaction, what is my tax liability on this? It's possible that could change. That's one of the things that was sort of floated as a rumor by the Trump administration, but I don't know if they will actually consider that. But that's one of the things that I personally say. Like when people ask me, well, should the central bank adopt a gold standard or a Bitcoin standard or something? I say, I would just like them to have monetary freedom. I would like individuals to be able to decide what they want to use. And if they want to use Bitcoin, great. If they want to use gold, great. Like Larry White, that's an economist that's written a lot about Bitcoin. And in fact, he has this book, Gold Fiat, Better Money, Gold Fiat or Bitcoin, that talks about many of the same things that we've been talking today. So he believes, I think that, look, if we gave people the choice of money, they would choose gold because people just like knowing that their money is tied to some physical thing. And basically every country and culture around the world adopted gold. Like everyone converged on gold. People just like shiny rocks, right? And so for some reason, everybody picked gold. And so it's a psychological thing, and that he thinks that people would go back to that. I'm not so sure. I think young people today are comfortable with electronic money. I think people love and know about Bitcoin. And so maybe people would start using that. And if that were the case, then the Fed would have to worry about people switching to these other things. And they would potentially, not have the ability to inflate the money supply as much because they know that if they do that, people are going to jump off of the dollar and use Bitcoin instead. If we get SBR or some other commitment, well, if we got the Fed or other central banks backing their money by Bitcoin, I think that would be some constraint on them, but it wouldn't be perfect because, again, if we think back to the Great Depression, we were on the gold standard and the Fed was still able to manipulate the money supply, create a boom in the 1920s, cause the Great Depression in the 1930s. And so it's no guarantee that it would be some limit, but it's not a perfect limit on what the central bank can do. However, it is a limit on, in the long run, they wouldn't be able to bail out the government if the government overspends. And we're worried in the United States, we're certainly worried about the size of our debt right now. And so that at least puts a limit that, the Fed can't come in and bail us out if we get into too big of a debt. And so hopefully it would have some constraint on overspending as well, not just on inflation and money creation. But again, those things are highly speculative. I would love to just see if we gave Americans the option to choose whatever they want. If any country gave their citizens the option, you can use whatever money we want, then yeah, I think we'd see a lot more usage of Bitcoin in the monetary system.
Yeah, great. That's a great quote to end on, I guess. So hopefully we'll see it in the future in some sort of way. But yeah, Thomas, thanks a lot for sharing all these insights with us. We didn't even get to talk to like your regular work and sort of how it intertwines and intersects with Bitcoin. But maybe we'll save this up for another episode. So thank you very much for coming along and sharing all your thoughts with us. And yeah, where can people find you? Just maybe for that.
Yeah, Pascal, it's been a pleasure to be on. I'm at the University of Austin, so there's some information about me on their website and BPI. I'm on Twitter or X, I guess, as Hogan Mon Econ is my handle there. So yeah, people can check out my work, and I hope sometime and we'll be able to talk about, like, I think actually there's a lot of lessons that we can learn from the gold standard in the pre-Fed period, because they did have a, limited money supply. They did have an interesting credit system that was all being done outside of the government. And so thinking about for Bitcoin, how the financial system can function outside of government, I think history has a great set of lessons that we can learn, and maybe we'll have a chance to talk about that another time. So yeah, thanks a lot for having me on.
Nice. Yeah, no, for sure. That's great. I almost forgot, like, there's one last question that I asked to every guest, and I just wanted to ask you, like, if we want to talk about similar topics with other people, is there any other high signal person, or economist that we should bring on to talk Bitcoin, monetary theory, and just like how everything is evolving?
Mhm. Yeah, so I think you mentioned at the start, I did this podcast with the Bitcoin Policy Institute with Josh Hendrickson and Will Luther, and we were talking about the future Bitcoin standard credit. Those guys are both great, but I also love two people I mentioned were Larry White and George Selgin, and they are the like older, they're both retiring monetary economists, and that have been talking about this for decades. And we're both cited, they've been inspired people like Hal Finney and Nick Szabo that have talked about the things that they learned from Larry and George. It cracks me up to see on Twitter people telling like George Selgin and Larry White that they don't know anything about monetary economics or they don't know about Bitcoin. I'm like, well, Hal Finney and Nick Szabo thought they knew a lot. So that's a weird thing to
Yeah,
say.
the OGs. Yeah, the OGs, for sure. Yeah.
So those are great guys to talk to. Yeah, I like, part of that reason is, they know also a lot about how do things function without the government. They've been thinking for decades about how we can have a monetary system outside of the government. And so I think that's pretty interesting for people that are interested and love to talk about Bitcoin.
Yeah, exactly. That's actually a good idea. So at some point, I think back in the days, I was talking to George and Larry themselves for when I was still writing my not PhD, my bachelor thesis. But we'll see. At some point, I might get them back on the show. That's for sure, because they have a lot of interesting things to share. That's for sure.
Right.
Cool. Thank you very much, Thomas. Have a great one. And yeah, see you around.
All right. Thanks a lot.
Thank you.